All is well. Everything's okay.
Amazing.
Yeah.
Well,
I mean,
we are very, very, very happy for having you today here at this masterclass. So, introducing myself, I am William, as we have talked later. I'm executive director here at the Angels, which is the alumni angel group for students, alumni students at F2V in Brazil.
cool.
Just to get you like a picture of it, F2V is one of the coolest business schools
I know
in
FGV.
Latin America.
My co-founder Diego attended FGV, so I know.
Cool.
Oh,
I know. Yeah.
Amazing. And
Pretty
we
familiar.
are very happy for having you today. Here's how we have the schedule. We have 3 blocks. First, we designed to talk about like Viva Real story and share like some insights, like how did like this an English teacher, a German backpacker, Diego, like from F2V, created one of the coolest real estate companies in Latin America. And then we will go for a Q&A, and then we have this other Q&A for the audience, and that will be very cool. So
Awesome.
From the audience,
it's great. I'm all yours. I'm all yours. Whatever you want to do.
Cool. So from the audience, like mostly we have like founders from our portfolio, alumni students from F2V. We also have some invited guests from the F2V ecosystem and other entrepreneurs. Let's get it. I guess from the beginning, we would like to hear about your story. I mean, I'm very happy for read the book Viva the Entrepreneur. I guess this is the hard thing about hard thing, but focused on Latin America, and since it's way more difficult to build a company in Latin America, I guess I think you did like a better job than Ben Horowitz. I guess this is where the bar is way higher, and I really recommend to everyone here to read the book. For those who will have the opportunity, we will share the link from Amazon,
Sure.
and also we'll ask them to give like some nice reviews about the story.
Thanks, man. Appreciate that.
The first thing that I would like to start with is how it all started. I mean, it was one of the largest transactions last year. You guys sold Viva Real for 2.9 billion reais to OLX Group. It was like an all cash offer, and it was like a landmark for the real estate market in Latin America. And I'm sure you are like one of the most well-connected entrepreneurs here. It's like the guy who knows everyone, and we are like curious to understand how it all started and share with us like the cool insights about it.
Thank you. No, it was. I'm really proud of what we built. However, when I look back, hindsight's always 20/20. Maybe we sold too early, but it's okay. There's always, as an entrepreneur, you're always thinking about, taking it to the next level. And but I'm not complaining. It was a fine transaction. So yeah, how it all came together. I guess I had been living in Colombia at the time, and I started as an entrepreneur when there was no ecosystem, right? There was no angel community. Now it's amazing. There's people that that are investing, in pre-seed and seed, and you've got like a community of people like this community. And so that was really hard in the beginning. We really struggled. And the funny thing is that there's a trajectory that if you look at it, it looks like, oh, we came to the market, we raised money, and we grew. But the reality is different, right? It's not a straight line. I mean, I before Viva Real, I had launched a bilingual blogging platform for real estate. Terrible idea. It didn't work at all. We worked on it for eight or 9 months and then launched it. And this was before lean startup was a thing. And then all of a sudden it was crickets. There was no interest in what we built because we didn't talk to the customer. And so I think that, there's a lot of precursor and story behind Viva Real. And a lot of times there's a lot of challenges that go into it. But to get to the answer to your question about how Viva Real happened, we saw that there was, I had a terrible experience finding property. We saw that there was an asymmetry of information. I got taken advantage of when I was trying to find an apartment, and someone, instead of helping me find a place, they sold me information, which turned out to be bad information. And so, like most startups, great ideas come from a pain or a problem. And so that was the case of Viva Real. Now, we didn't initially think Brazil, but when we launched the business, we thought about all of Latin America, and we quickly realized how difficult it was to be in all these different markets. And so when we kind of double clicked on it, we saw that Brazil was just so big. And that's when we decided to go AAB, all about Brazil. And I moved to Sao Paulo, and we focused exclusively on the business. But it was the early days were like, we couldn't raise money, there was no capital available. It was hard to hire people because, it was more popular to work at an investment bank or consulting. And so we struggled a lot.
I see. And following that point, mostly we see like all the time, like tech companies in Latin America, they mostly are born, like they start out with like the copycat idea from the US or something like what already exists in the US. They try to do it in Latin America. And I recall like you mentioned in one podcast episode that you guys saw like the Mercado Libre case and try to like create a Mercado Libre for real estate, and that was something how it all started. What was like the challenge back in time when you were trying to fundraise, go for investors and say, this is the thesis, we are like I am an American trying to build this in Latin America, in Brazil, but I have no connections in the market. I mean, that's very powerful to understand how you guys like did that.
Yeah, William, it was just sheer tenacity and determination because, first of all, at the time when we started, it was the economic collapse, right? Which real estate was at the center of that, right? And so when we went out and said, we're going to build a real estate startup in the middle of the backdrop of a real estate crisis and a mortgage credit crisis, that was like, all of a sudden, all the investors said, that's a dumb idea. It's like, don't you understand? Real estate is completely collapsed. Like, why would you build a business while real estate is falling apart? And to add to that, we're going to do it in Latin America, Brazil. They're like, that's even a more stupid idea. There's no companies in Latin America. There's no billion-dollar businesses. As investors, why would we invest in that? And one thing that I really understood was that it was just a matter of time. When I looked at Australia, Germany, France, the UK, and the US, there were businesses that were multi-billion-dollar companies in the same sector. So it's not like Brazil was like just all of a sudden it's impossible to do. It's just a timing issue. And we've seen that with the venture ecosystem over the last 5 years. Now there's like many more companies. You've got new banks, you've got, Quinto Andar, you've got Rappi, you've got Wildlife, they've got all these companies that are building massive businesses from Latin America. But it was hard to get validation from investors because whenever you're building something and you're, investors, the reality is that VCs, a lot of them, want to be very kind of courageous and invest and be the disruptor. But the reality is
mostly they're waiting for signals, right?
The human psychology is you don't want to look stupid, right? Exactly. Even investors, they don't want to look stupid. And so it's hard to address that. But yeah, the signal is important. And we frankly had zero signals because I didn't go to a top university. I hadn't worked at another tech startup. But that definitely changed when I brought on two amazing angel investors. So I brought on a guy by the name of Greg Waldorf, who was the first investor in Trulia, which in 2014 sold to Zillow for $3.5 billion. And then the former CEO of a company called REA Group, which today is valued at $10 billion, a listed company. So both in real estate, both in tech. And so for 30 months, I was out raising money. No. Why would I invest in Brazil? This doesn't make sense. And then I got two amazing angel investors. And then all of a sudden they're like, you know what? Maybe this guy knows something, maybe he might be onto something. And so that kind of shifted the mentality. And also the ecosystem matured over that time period.
I see. And the VC tech scene back in time, like say 2009, 2010, when it all started, I mean, we had no like the same amount of like venture capitals we have today. One of the things I see back in time is that mostly to be successful 10 or 12 years ago, the VCs were the guys who had like money, and they just sat on a deal and they were waiting, like buying time, waiting for the company to grow, and then they will decide, okay, let's do it. I think that's the moment. And it was a very expensive money. Like they were very aggressive on like term sheets and deal terms and so on. Specifically about your deal, when Viva Real raised like the first round, how it all started? Because we are mostly here angel investors, and things have changed drastically. I mean, everything is different now. We wanted to see how was the angel scene, which actually almost no angels were there, compared to today. What do you see like the big differences, and how excited are you with this new moment of Brazil and Latin America?
This is one of the best times to be, a founder, and it's a great time to be an angel investor too, because, and I'll talk about the angel investing piece because I've done quite a bit of that, and actually before our call, I wrote out 11 tips for angel investors. I was like, let me just think of some ideas. So I've got, cool. If we have time, I can go through the tips for angel investors at the end. But, it's night and day, right? I mean, the only capital available at this time was, international investors, like angel investors. So, I think the only local angel that I got was Julio Vasconcelos, right? Which, early, Facebook, Peixe, and now Atlântico and Canary. And so he was one of the first people that wrote a check, and that created a lot of like local goodwill also, because he was someone very respected. But it was like, in the beginning, it was like pulling teeth. That's an expression in English where it was painful. It was, I didn't look forward to in fact, just to be very candid and open, I would physically get sick, like, because of how stressful it was. I developed this kind of like stress cough, because when you get rejected so many times in a row, it's very demoralizing, and it takes a physical toll. So yeah, that it's night and day. I mean, let me give you the counter, the juxtaposition of, how much it's changed. It's dramatic. I have a company that I'm starting with a couple of co-founders, and I'm going to be the chairman of the company and put a little money in, and it's going to be a global prop tech. And that company, we didn't even go out and raise, and we had a term sheet from an investor delivered to our house with a box of chocolates. This is quite the shift from me begging people to put in a 50K check into the business to getting a multi-million-dollar term sheet pre-seed with a box of chocolates. So I think that kind of does a good representation of where we are in the development, right?
That's cool. And when we started GV Angels, the whole idea was we have like alumni students. We want to bring value to these companies, and we want to help them with the previous experience of other alumni, like tech founders, executives, and so on. But this is like the cheap talk. Like everyone in venture capital says, like we will add value and do stuff and stuff. As a founder, like back from the 2010 and like from the very beginning, you had the opportunity to talk with like several investors. And what is your advice about like fundraising now compared that what you had like back in time? What has changed? And there is one chapter on your book that I think it's amazing, which is what is your advice about advisors and board and of course angel investors?
Sure. There's a lot to unpack there, right? Where should I start? Where should I start with that? There's so many different avenues I could take it. What would be the most relevant?
I guess since we are talking about angel investing, this is where we will add more value here.
Yeah, I mean, my advice for angel investing, I mean, I can maybe jump ahead to the 11 tips that I have. I think that, you know, I can start, I got a lot of advice for angel investors because as a founder, I've been through the process of raising capital. I've been through the process of scaling a business, and I've had the good fortune of investing in about 60 companies now as an individual angel. So that it creates a tremendous opportunity to, you know, see patterns, understand what's the right thing to do. And I can identify the mistakes that I made as an angel investor. So I would say, first off, the things that I advise for angel investors is start out small. You know, don't be overly concentrated because you've got to follow the power law, and the power law in venture capital states that the returns are highly skewed towards a small number, you know, of big winners, right? And so, you know, a small number of your future returns is going to be concentrated in those big companies. So if you go too heavy into one company, you might miss the one that's going to be the quinto andar or whatever the company is. So it's important to have, you know, smaller checks. And also I made the mistake of being too heavy in one company, and then you're like, gosh, this can't fail. And that doesn't help you. That doesn't help you in serving the founder, because if you have so much pressure that the founder needs to make it work, you're not going to be a good listener. You're not going to be a good supporter. And so that's the first tip I would give. Do you want me to keep going? I've got a lot of tips.
Let's go. I guess this is the time. Let's do it.
So the second one I would say is move in packs, which is great. Here you have, you know, this group of you know, there's 78, you know, people on this call. It's so important to do deals with other investors. And this, you know, this is critical because, you know, you've got the opportunity to kind of leverage the network and the syndicate of people. And that's something that allows you to kind of strengthen your position as a group. You know, when I say move in packs, don't be a lone wolf. You don't want to be a wolf. You don't want to be too overly aggressive, but at the same time, you can have a little bit more protection if you're working in a group. I would say that going back to the first one, don't invest more than you can afford to lose. I already kind of stated that. I would say another key piece of this is invest in teams over markets. Amazing teams, they just figure it out. I'm not smart enough to understand every market. If you have a strong thesis based on some unique experience and you have an A+ team going after that market, that's even better, obviously. But that isn't always the case. And I would say prioritize team over the market.
And Brian, I mean, yeah. Since we have this opportunity to go like one by one of your key points, what is your math about like spraying? Like, do you have these? I'm planning to do a 10K, like 10K US dollars per company, 25K US dollars per company, or do you plan like for an angel investor? Do you think like a 50 companies portfolio is enough for, you know, dealing with the power law? What is your thoughts about it?
Listen, I would definitely, well, first of all, when you're starting to angel invest, one thing you don't realize is that the deals you're getting, you're comparing them to other things that you've seen. And they're probably, when you start out, they're probably not the best deals in the market. Because if you don't have any background and they're getting to you, it means that you're just seeing whatever's out there, right? So you have to be realistic about that, right?
Luckily, we are together on Flourish, so I guess we are getting started.
Are you in that deal?
Yeah, sure.
Good. That's great. That's a good one. So I think that that's something that to be aware of. But I do think that like you definitely want to be spread out. So let's just say that you have $100,000 to invest. I would encourage 10K checks or something like that, more than I would say, 2 or 3, 25, 30K checks. It's just better. Your probability will be better. You'll find the one that hits. And so I would encourage, now you've got to decide what your check size is, and you've got to look at your whole capital base and what you have. And maybe it's 5K. The good thing about writing small checks is the best deals, it's counterintuitive. The best deals are hard to get into with a big check. So when you have a small check, you can slide into a deal pretty easily because you're like, it's 10K, man. It's, it's just 0.1% or whatever. It's a very small amount. And so that's an advantage. That's actually a feature. It's not a bug. You want to be flexible in that. So it's counterintuitive, but like people think that having a bigger check makes you be able to have more kind of opportunity, but it's actually the opposite. Smaller checks afford you to get into the best deals. So to answer your question, I would say err on the side of many more companies with smaller checks for sure. 15, really 20 companies, but also ideally you don't stop investing over time because when you pull back, that's when you miss the opportunities. If I think about my first couple investments I did Quinto, and I did a couple other early ones, Quero Educação, and a couple early investments. And then I stopped investing because I was running the business and I was too busy. I missed so many companies that I could have invested in just because I thought it was either a distraction or I didn't trust my own judgment or whatever it was. And so you want to be also relatively consistent in your investing.
And on that point, have you experienced like syndicating deals and, like leveraging like the power of your influence with other like co-investors?
Absolutely.
Before Latitude, was that something that you were trying to create before Latitude? And
I participated in many deals with other people. Like I would get a deal from somebody and they would, the lead syndicate was in it and it was someone I know and someone I trust. And I would, do a very small, amount of due diligence because I kind of trust the other person. I mean, I do that a lot with like, the Florian and Matze. I've done a bunch of deals with them, and a handful of other, Ben and Tiago from Gilbolso. Like, so there's a group of people that, that we co-invest together. Sergio from Creditas, another guy that is an active angel investor and someone that, when I see a deal and he's in it or I bring him a deal, I think that we are at the starting point of more syndicates. I think that we should create the practice of having a syndicate, a lead syndicate, and then other people following. And I think there actually should be carried interest for the person leading it. It's not something that we see very often, but it's a lot of work to organize a deal, herd cats to like get the deal in and, pitch it to other people. So I do think that's something that we'll see more. And I would like to see kind of that become more common practice, where there's, someone getting compensated a little bit for the deal. Historically, when I raised my first capital from Greg Waldorf, an angel investor, he ended up putting the deal together. And it was amazing when I brought him on because we circled up $1 million in like 3 weeks, right? Which was a lot of money in 2011. And he became a board member and advisor, and he took he took a little bit of equity in common stock for that. I wouldn't give equity away for putting a deal together unless that person is putting a bunch of money in. So I advise founders to avoid a broker for a deal. I don't like brokers in those deals. But if someone has some skin in the game, they're vouching for you, and they, this allowed me to get Mickey Malka from Ribbit Capital involved, Wences Casares, So I got these like huge names that came with Greg's check. And we formed a syndicate and did $1 million. And then all of a sudden, a lot of those people that were in the syndicate were LPs in Monashis and Kazek. And so it was like a direct connection into those funds. And so these are all things that are kind of the practice of stage financing, I think is good to get key people in your early seed rounds.
Cool. And following again on this point, well, I mean, I saw your conversation about angel list, and you guys are like working on a rolling fund on angel list, and I guess you already have this experience about how to syndicate deals there. What is your thought about it? Do you think angel list will be the next? I mean, will be even more popular in Latin America, and we will do more deals over angel list from time to time? What is your thoughts about it?
If it's not AngelList, it'll be some platform. I mean, it's hard with a company like that size. Like, that company is huge now, and they're growing really fast. So it's just like many things, right? Latin America has different, ways of operating. The other day, I had a deal blocked because it was a Delaware LLC, which is the right structure if you're going to create a Cayman on top. But it's not normal in the US to invest in an LLC, because LLCs usually are like reserved for the creator economy. And, it's not the right structure. So that's something that, we'll see if they adapt to it. I mean, if they don't, I'm going to try to build a solution if we get around to it. But, I think that there needs to be local solutions. It's the same thing as, being a copycat. You end up tropicalizing anyway, because there's different needs. And, Stripe Atlas is a good example. Stripe Atlas is an amazing product. You can go create your company in a click of a button. But if you do that, you end up creating a C Corp, which, like me, you end up losing $100 million in enterprise value because you created the wrong structure. So that's one example of like something that we'll solve. We're going to be probably launching at the end of the year Latitude Go. Latitude Go will be the place where you go create your company online and have everything venture backed ready, integration with a bunch of other products like Slack and Stripe and Twilio, and that's something that can shorten the curve of the time it takes to start a company. So I think that we need local solutions, right? And the U.S. companies, they're not going to solve Brazil's problems. They're worried about what they're doing. And so, listen, there's a tremendous opportunity for this stuff. Our rolling fund, it's not really a syndicate. It's like a traditional fund. The only difference is that we have a subscription. And so the way a rolling fund works, it's very cool. I think that anyone listening here, I think it might be an interesting solution if you don't want to raise a fund, but you want to start taking on some LPs. So the reason why I started the rolling fund was because I didn't want to deal with any back office things. I don't want to deal with K1s or any accounting stuff. I'm allergic to that because I'm a founder. I just like to find the founder, invest in them, and help them. I don't want to do anything else. So a rolling fund
doesn't give you any edge, right? I mean, it's just like wasting time.
Wasted time, totally. So the rolling fund, it's a series of kind of a series of SPVs. Every quarter is a new fund. So for example, I've got a couple LPs, they want to put in 200K. Great, put in 200K. They subscribe. So every quarter they put in 25K. And then every investment I make during that quarter, they have exposure to. And so it's a pretty unique model. And it's all digital, all online. And I think it's a very innovative product.
Cool. I guess we were on the fourth item from the list.
Okay.
Tips for angel investors. So just don't want to lost.
Yeah, no worries. Last comment, William, on the rolling fund that's unique. Also, just so everyone listening here, normally when you have a venture fund, you can't actually promote the funds and solicit money. There's rules in the SEC that don't allow for that. There's a change in the Jobs Act in the United States that allows for you to go and solicit capital publicly. That's another detail of interesting thing about a rolling fund. If anyone wants to learn more, maybe I'll write an article and share it. Number five, don't try to be involved in the operations. This is a hard one for me, right? Because I'm an entrepreneur. I built a bunch of companies, and many entrepreneurs turn investors. They want to steer the ship from the shore. You can't you can't tell the company what to do if you're not in the day-to-day. And so when you find yourself doing this, you're flirting with a little bit of trouble. And it's okay to give advice and ideas. That's fine, but don't try to be too involved in the deeper decisions. And good founders, they selectively take advice, but they know that they have a better perspective than the outside investor. And so that's an important one to remember. It'll create friction if you don't listen to that one. Number 6, good judgment is important, but it's not as important as you think. Now, what does that mean? Listen, these early investments, these early stage investments, these aren't private equity deals, right? If you dig in, you do a ton of research, the really good companies will already be funded by the time they're ready, right? So there's obvious areas or sectors that you want to avoid probably, but if you're making an investment decision, based on what you see on TechCrunch, that's you're probably chasing something that's already in the past, right?
Yeah, you're right.
Number 7, so I would avoid non-tech startups. That's just me. There's maybe good opportunities in non-tech, but the largest companies of today and the largest companies of tomorrow are in tech. So because, yeah.
I mean, on that point, what is big enough for you looking for total addressable market? Do you have your own metric about like this can be huge, I'm on it, or that's too small?
I think that investors overstate the importance of that because there's tangential opportunities, and usually when you're when you're building a business, you have something that's like, it's your kind of, I think Edson from Astella described it like as, a praia que você entra. I don't remember how he described it, but like, and then there's tangential opportunities that come. So I think that, listen, if you listen to my podcast with Shu from SoftBank, this is a $5 billion fund. He said we like tiny markets. He said, like, which is hilarious for someone from SoftBank to say, but it's something to think about. And I think that people obsess about massive markets. You obviously don't want a market that's not going to be able to grow, but sometimes the market can expand. And I think there's too much emphasis sometimes on, is this market big enough? It's hard to predict markets.
But Brian, on this surfing curve, on this point, you were you had a startup that's not exactly a SaaS, only a SaaS. It has some real economy things going on. So there's a big recommendation here: go for the SaaS, go for the SaaS B2B. Softwares are sexy for angel investors because of their margins and
yeah.
Do you agree totally with that, or is there any space for disagreement that you can?
If I look at my portfolio, software as a service is probably, I don't know, it's a minority. I do think that like software as a service is a very easier thing it's more predictable. So I understand why there would be a lot of emphasis and focus on that. I tend to focus on like a couple different areas. I focus on marketplace businesses, software as a service businesses, fintech, prop tech, ed tech is something that I'm paying more attention to. And the software as a service is just the business model, right? So I think that obviously I like recurring revenue just as much as anyone else, right? That's when it becomes predictable. When it becomes predictable, that's where we like to be, right? But I think that like I wouldn't say that you should totally isolate yourself in that way. I think when there's a big opportunity, there's a team that's really perfectly fit. There's good founder market fit, and you've got a huge opportunity. The business model will take care of itself. Ideally the business model is smart, but if we're investing really early, sometimes the team hasn't nailed it yet, and that's okay. Some of the best companies I invested in, they hadn't nailed it yet, and then they figured it out, and then they started scaling it after they nailed it. So I think that I don't have a hard fast advice on like software as a service is if you feel like you understand that best, and you understand, maybe you were a VP at a software as a service company, and you've got a good understanding of it, then obviously you should focus on your strengths.
Amazing.
On that topic of the team, just I had this one, and Fernando have a question here on the Q&A. I think we can putting
Okay.
out the good bom gancho, a good hook for this question. Maybe I don't know if it's in English the same. But on the topic of the team, you said, and you here before, and in your book, you have said that you are not, you don't have a very shiny background. Let's put it that way.
Yeah.
Ivy League. So maybe sometimes we have investors have a bias on that. We're looking for Stanford, we're looking for maybe FGV. We try to see some
not maybe. I guess most of the time.
Most often we look for it. But aren't we biased? Are there any other elements or characteristics that for you can identify a good team, a good founder? And the second question, would you invest if you could go to the past, get a car and go back to the past, travel in the future? Would you invest in yourself back then?
Very good questions.
Good business.
I got two questions here. Let me just restate them. The first one is the bias and the signal, right? Like if you go to FGV, you're recognized as going to top business school. It's a signal. Are we biased and in terms of prioritizing those types of people? And then the second one is what I invest in myself. I'll answer the first question first. There's a massive bias, and it's hard because there's kind of a, it's a judgment that people make. Again, people want to avoid looking stupid, and so you look for signals like the person worked at Mercado Libre. They are good signals, right? So they are elements. If you take no signals, it's harder to select. I do think that there's an incredible opportunity, and the way I would look at it is, the first question I would ask is, why is this person starting the company? I invested in a woman from Belo Horizonte. Her name is Laís. She actually has a signal because she went to MIT, but she's building a healthcare company, and her mother suffered cancer. She went through the cancer process, and so she was bounced around in the healthcare system, and her intrinsic motivation is so deep and so strong because this is like a life-changing thing for her. And so that to me is I was like, here's some money. You smart. By the way, she already ran a company in the healthcare sector and brought it to profitability, but it was in a small town and didn't expand. So many signals, but I do think that the overstating the Ivy League or I think that I prefer hustle over everything, right? I mean, there's a lot of people that went to top schools. So how have they demonstrated hustle? In my case, I can give you examples of hustle, right? I remember when Benchmark, one of the investors from the US, they were down in Brazil, and I heard that they were in Brazil, and then they ended up, I sent a message to the partner, and he was on his way to the airport, and I said, I'm going to meet you there. And I went and I met him at the airport. It's just straight hustle. And to me, those are the right signals that go beyond, the pedigree. But pedigree is also important, but I think that it's people overemphasize it because it's a signal that's easy to identify.
And would you invest in yourself back then if you could travel back to the past?
I think that I don't think I would have, if I was a VC, I think it would have been hard for me to invest in myself, but I don't know. I like to think that I invest in super scrappy people. I think the answer is yes and no. I'm being unfair with my answer, but probably no, because it was very clear I didn't know what I was doing. So I think I would have seen that I didn't know what I was doing. But I do think that probably I would have seen the hustle and the, o brilho no olho, no? Como falam em português. And that was something that was, I think, I eventually did get some investors to invest early. But so I think the question is probably not, but in the very beginning, I definitely wouldn't have, but I think I learned pretty quickly.
Cool. I mean, I think we already started the Q&A all together with Liz, but
yeah,
it's going okay. It's been very, very cool to learn through the process. And before we started to the next point, your next tip, we have one question here from Daniel, which is,
it's a good question. Yeah, I see it. Yeah.
Oh, okay, cool.
Yeah, I'll just read it. So the pre-seed, funds that are trying to hog on pro rata rights. Your question, Daniel, is: are pro rata rights important or a requirement? So, as an angel investor, I don't insist on pro rata rights. I think that I should be earning pro rata rights, and I can even earn super pro rata rights if I'm amazing as an angel investor. I take a massive pride that a lot of the investments that I make, the founders say that I'm their best investor they have. And then when the time comes and they're raising their next round, I'm like, hey, can I put in a little more money? And they're like, absolutely, because I want you close. So I think that it's lazy just to get pro rata and then just do your pro rata. I think that every early stage investor should earn their pro rata. And the reality is, it also helps if you're moving in a group, because then it's easier to enforce some pro rata. Like if you put together a $500,000 round with a bunch of angels, it's more reasonable to ask for pro rata. But as an individual, I think that it's too much to be asking for pro rata on an individual basis. And I think that you should bust your ass to generate value so that you're invited back. And it's okay to tell the founder, hey, I want to do some pro rata. I want to be able to reinvest. And if you're proving value, the founder will happily let you invest.
Cool. And following on that point, I think most angel investors, they need to reserve a part of your dry powder to follow on their investments, right? Because
yes and no. I don't know. That's a debatable topic. I think that the reality is, I don't think you have to do pro rata all the time. I mean, it's great if you do, and if you have a breakout company. The reality is that if you have a breakout company and you have a network and you don't have the money, and you have the allocation, you'll get the money.
I see.
So that's what I think anyway. So I don't actually, in our fund, we don't set aside anything for pro rata, zero. And this is maybe different than other fund strategies, but if there's an amazing company, and we just deployed some capital in a company, it'll be public pretty soon, monster round, and we were the first check in, it's going to be, if it's pro rata, it's going to be multi-million-dollar pro rata probably, because it's an enormous company. And if it's a hot deal and Sequoia wants to lead it, I'll send one email out and I'll have it filled, right? And so I think that if you're an early stage investor, I think it's more important to have the power law dynamic and more companies rather than go super deep. Because if you have out of your 30 companies in your portfolio, if you have a breakout company, it'll be easy for you to find the money, because it'll be an oversubscribed round. And if you have pro rata or you have an allocation, it'll be easy for you to get the money.
Cool. I guess we have a following question in the Q&A. Actually, two following questions.
Yep. Bring them on. Bring it on. Maria and then Anonymous.
We have one from Maria Lisi from the MIT Angels. How was the merge between ZAP and Viva Real? The challenges and tips of merging cultures and execution. How challenging it is to put two competitors together over the same roof and start working. Maria,
we don't have enough time to cover this. No, I'm just kidding. I'm gonna. That's my way of saying it's very complicated. I'll share a couple lessons. So first of all, this was a merger of essentially equals. We were, they were larger than us, but we were growing faster, and so it was essentially a merger of equals in that sense. It was a bit odd because there's two very different cultures. If I compare my deal to, the example of, oh, cool, you're one of the founders of Plante Mobile. That's awesome. So you're part of the story here. If I compare our deal to like, Zillow and Trulia, that was more of an acquisition. And then, you could just kind of merge all the teams and you can, let some people go. We made some mistakes. So one of the mistakes we made was we were kind of diplomatic in the transaction. And, we had built a business a lot faster and with less capital. And there was just two very different cultures, Zap was born in Globo and, acquired by Globo, a media company. And, Globo is impressive in many ways, but, there's a reason why we were the attacker with less money that was growing faster than everybody else. And so I think in retrospect, what I would have done is I would have been more assertive. And instead of trying to be diplomatic, we said, okay, we're going to merge. The one thing I wasn't diplomatic about is I said, the CEO must come from Viva Real. And because I knew that the culture is set from the CEO. And so we insisted on that. But we tried to take someone from marketing and someone from sales and then engineering, and we took who we thought were the best people from each team. And the reality is they might have been the best people, but the culture was so dramatically different that it didn't matter if they were the best people or not, because you need a unified, you need to be rowing in the same direction. And there was just a different way of doing things. And so that created a lot of friction. It created a lot of headache, and it made us very slow. And so I would say we lost 9 months until we decided to essentially fire most everybody and recreate part of the management team. And so that was a very problematic mistake that we made. So in hindsight, I would have been much more assertive there. I think that, trying to kind of integrate different parts of it, we should have just kind of taken more of a lead there. There's many other mistakes and lessons. I think when we had to let a bunch of people go, and that was very hard. I think we did a fairly good job, and it was human how we did it. And I think that one thing, when you're letting people go, it's not about, you obviously take good care of those people when you're letting people go in a merger like this. But the reason why you take great care of them, besides doing the right thing, is it sends the message to the rest of the organization that's staying, right? So that's something really important, is to treat people super well. I made personal phone calls for people, trying to get them jobs in different places. So those are all things that I think are really important. But yeah, Maria, we could talk offline here, but there's 100 lessons and it was very hard. And I say M&A sounds sexy, but it's, there's a reason why the Movili, guys have gotten really good at it, because they've done it 15, 20 times now. And it's not that easy.
Well, Keen has a question here, and I also would like to talk to everyone on the audience that if you don't feel comfortable writing or speaking in English, just feel free.
Eu falo português. Então, você pode fazer a pergunta em português. Eu falo português como uma criança de 11 anos, mas de todas maneiras eu vou entender tudo que você escreve ou fala.
Okay,
should we read the question from Kim?
Yes, sure. Let's do it.
Yeah. So how active, close to the founders can you be with 50 investments? As a founder, how much dedication did you expect from your angels? And what do you think is the most value add to give to your investees? It's a great question. I'm pretty available to the founders. Like, sometimes I go a little crazy because I do get messages like, at all times. And the funny thing about this is like, it kind of moves in like, there's an expression in English, when it rains, it pours, right? So like right now, everyone's raising money, right? So I'm getting, 10 calls, this week about, hey, I'm raising capital. Can you make an intro? I would say that, listen, the number one thing I think that you can do that's scalable is just to be an emotional supporter of the founder. It's such a hard journey, and it's so difficult, and it's lonely, and it's, solitário, es complicado. Cada dia como parece uma montanha-russa. If you're just like a compassionate, empathetic person, that's very valuable. Like, founders don't have an outlet. And the difference that they can, they can be more vulnerable with an angel investor. It's different. It's kind of hard unless you've developed really deep relationship with your VC, which I was fortunate to have an amazing relationship with the investors. It's hard to just be completely open, because you constantly have to put on a little bit of a show because you don't want them to lose faith in you. For me, when a founder calls me, I'm happy that I'm the first person the founder calls when, I'm not going to name the name of the founder, but this founder called me and he said, Brian, the pandemic happened. We're running out of money. We had a term sheet for 25 million. They pulled the term sheet. In the next 2 weeks, we have to fire 90% of the company, or we have to take an abusive term sheet where we're going to end up basically destroying the cap table. What should I do? And I'm like, that's a tough decision. What do you think you should do? And I let them kind of, express to me. And then I gave him my 2 cents. He went out, he put a deal together, and he solved the situation. But it was just nice to have someone that was empathetic and supportive and could help him think through that scenario.
That's a good point. We have one question here. The person didn't identify it himself. So what about elder founders? Have you invested into anyone who was a senior?
I like how 40 is the new elder. That's pretty fun.
Yeah,
I'm 40. I'm in my 40s. So 50s, 40s. Listen, I have a handful of investments I've made of people in their 50s, founders. I think that, first of all, hustling is not, you don't want to be unhealthy in your hustle, right? Because you've got to have a balanced life and you've got to try to, it's not a balanced life being a founder, but at the same time, you've got to take care of yourself because this is a marathon. It's not a sprint. So I think that just because you're not in someone's not in their 20s and they're hustling, I prefer a seasoned entrepreneur that has been there and knows how to build a company and knows how to be a good leader and is not going to have the same kind of issues that a 22-year-old founder. So I don't think that in terms of age discrimination, I actually, age is not even a factor for me. I can invest in a 22-year-old founder, which I've done, and I can invest in a 55-year-old tech founder like I did recently. There's advantages and disadvantages. I look at it as the entire spectrum of experience, right? So to me, I think it's a non-issue. And, hustling is important, but at the same time, I'm much more efficient than I was at 25.
Cool. I wish we met and Brian Requarth founder, we will pretty much sign the deal immediately, right? So Brian, I guess we were on the 7th.
Yeah. All right, let's finish it out. All right. So here we go.
And then we finish and move to Latitude and a little bit about that.
Okay, cool. So I said avoid non-tech startups. The number 8, be fast and get to a no or a yes. This is one of the ones in Latin America where things move a little slower. And historically, like you said, William, investors in the past didn't need to decide quickly. It's you sit back kind of in your leather chair and it's look at, I've got the money. What do you need my money? So I think that's times have changed. And I think that founders respect dealing with me because sometimes I'm a 1-call close. I'm in, let's go. Sometimes I'm, a 2-call, but I try to get back to someone within a week of hey, I'm in or I'm not in. And sometimes if I'm just not sure, then I usually say no. And so I think that's something that's really critical because there's nothing more annoying and difficult and frustrating when a founder is just waiting to hear back. So you can improve your reputation by being fast, even if it's a no. I respect investors much more when they tell me no and they do it in a quick way. So I guess that connects with the next number 9, which is if you can't decide quickly, don't invest, right? I kind of already said that, but I think it deserves highlighting. Number 10 and then number 11. So number 10, keep the terms as simple as possible. Now, this is easier nowadays because we have a safe and we've got convertible notes. But
In States,
man,
right?
what's that?
In States, right?
Yeah.
In Brazil, we have lawyers who compete for
Yeah,
contracts, clauses.
this is, it's people that try to over negotiate the terms. Well, first of all, if an angel investor is negotiating a bunch of terms like this, that's make the deal much more complicated. I just advise founders to just run, like, just doesn't work. And so, don't try some like really special, cute liquidation preference, like aggressively, and you're going to send the wrong message to the founders, particularly experienced founders. If you're talking to a 2x founder that's raising for their new startup, and you're trying to throw some of that stuff in, you're just going to create a bad reputation. So follow the market standards and be fast. The last one, fechando com chave de ouro aqui. I don't know if it's the most important. It's probably not, but it is important. Try to have a range and stick to it. Like, this is hard because the valuation does impact your outcome. And so you've got to have some discipline. You should have a comfortable range with pre-product market fit, pre-product market fit companies. And there's always going to be outliers, and that's okay. But you've got to have some discipline. So, and don't be too picky on the gap being a few $100,000. I've lost deals, and I've seen deals be lost where it's like the difference is $300,000, and it became just such a non-issue. So either the company blows up and is super big, and it doesn't matter if it was $500,000 more on the cap. And so, and the last thing I'll say, which is a little bit breaking my advice here, sometimes there's these deals that don't fit in the scope of like the valuation range, and it's sometimes those deals that are the ones that are interesting. So you have to watch out for the outliers, because I look at Loft, like I saw that and I'm like, man, this is too expensive. Like, and I stupidly passed on it. Rappi, when I saw Rappi, it was at a $50 million valuation. Now they're probably raising at a $6 or $7 billion valuation. So it's part of the, what seems expensive sometimes is expensive to miss. And so you've got to be able to identify those opportunities.
And that's a very, very important thing that you just mentioned. Sometimes we have this judgment about how can this company be evaluated in like $7 million pre-revenue, pre-everything, and like kind of Y Combinator company on the demo day. What are your thoughts over it? What justifies, paying more for a company? Is it the team? Do you anchor your decision on the market size? What is like the key thing to like have an eye and decide?
Yeah, I think that like there's no secret recipe. I think that, for me, if I can imagine in my mind that this thing can be big, like I look at, obviously you look at the team and you look at the market size. Those are the two main things that you're going to be evaluating in the early days. I think that it's really hard to like, and it's a little bit of like, it's that, and then it's a little bit of like fairy dust, right? Just to be honest, there's an aura about the business. So that's hard to explain. And I wish it was more data driven, but the reality is that like I'll give you an example. There's a company in Latitude that was in our last cohort, and I was like, this is going to be big. I just know it. I threw $150,000 check in at a seven post money, which was a PowerPoint. It was ridiculous. They just signed a term sheet to raise at a 36 post, and it was a month later. So it doesn't make any sense, but now they've got a bunch of money on the balance sheet and they're going to go out and build it. So part of it is the ability to communicate the vision, to articulate how this becomes big, and the ability to kind of get amazing people on board and create momentum for yourself. Momentum begets momentum. More momentum creates more momentum. So, those founders that are able to create that initial momentum, there's a good chance that they're going to be able to create the momentum moving forward. And so a lot of times, it's hard because you want to look at things like is this the best product? Oftentimes, the best product doesn't win. It's the company that gets the most distribution for the product, raises the capital, then builds the best product. And so these are kind of hard things to pinpoint. But yeah, I think that at the bottom line is it's a mix of like market size, team, and then a little bit of like ability to communicate and create a vision that this is going to be big.
Cool. I guess we have one question from Marcela, and then we can explore a little about Latitude, right? We're getting 1 hour call.
Sure. So Marcela,
you want me to read it?
No, it's okay. Marcela, the question about the future of real estate, how do you see the use of data, technology, and development of the real estate product? I'm going to answer the first question, and then I'll get to the data piece in a second. I think the future of real estate is that we're going to see much more buying and selling of real estate through companies instead of individuals. So when you sell your property, it'll probably be a company that buys your property. I think this is the future of how real estate will transact in the future. You know, obviously data becomes an important play. Like when we were at ZAP, we had VP Zappi, and we developed some kind of pricing. We did a lot of analysis on pricing trends. You know, if you look at what's going on in the US right now, Zillow is buying properties sight unseen because they have enough data to be able to quantify and understand the value, and they're able to do it almost at the same price as you would get normally. So I do think that doesn't mean that agents won't be involved in the mix. I do think that the structure of real estate is kind of broken. Like in Brazil, you have this like imobiliária, and then you have gerente de vendas. E você tem corretor que reporta para o gerente, a gerente. No faz sentido. Like you have all these layers of managers managing managers, and then the cost of the transaction is really high. And so I do think that individual agents make sense because, it's a complex transaction. But I think that the future of real estate is going to be much more transactions between companies. Like you'll sell to a company, and then there'll be an agent that facilitates that. And then data. Yeah, I mean, listen, I think that data is absolutely critical. Data is important in every aspect. So, you look at my house that I'm in right now, right? This house, when I bought it, I knew exactly what my neighbor paid for their house. I knew what the other neighbor. I knew how long it was. I knew how many days it was on market. I knew that it was almost transacted 2 times, and then it fell out of escrow. And escrow means that it was signed and then something happened. So like I had all this information, and the problem with real estate is that there's an asymmetry of information. So anytime you have an asymmetry of information, someone has an unfair advantage. And so I think that data will play a role in creating a lot more transparency about the process. And then I think that like the digitalization of real estate also, I mean, the whole cartório thing is just ridiculous. And I think that there will be hopefully blockchain to support to replace that at some point, or some other kind of ability to kind of transfer ownership. So yeah, listen, I'm very bullish on real estate. I think that that it's one of the largest asset classes in the world, and so we're going to see a lot of innovation in the next decade.
Cool. Well, I think we still have time for one more question from Adriano.
Okay, let's do one more, and then we'll close it out in a little bit. What's your rule book, if any, on corporate VC or strategic enterprise investing alongside and around? How do you balance the benefits of having a strategic partner and the risk associated with probable different agendas on the exit discussion, for example? Adriano, great question. So I have a strong opinion about this, not surprisingly.
Cool.
I think that there's a separation of corporate VC, and then like one of them is like Mercado Libre has actually a fund that's disconnected with Mercado Libre and independently managed. And then there's disguised corporate VC, which is an M&A arm of a company. And, like Google Capital, G Capital, right? Enormous venture fund from Google. Google's not going to make you sell to them if you don't want to sell to them. And they're not providing some kind of, there's a Chinese wall between the venture fund and the corporation. So my opinion is, if it's a true corporate VC and it doesn't have the, it's not a disguised M&A, kind of project, then I think it's fine. And I think it can be very helpful. Like, I would take Mercado Libre on my cap table, but to give the Mercado Libre example, in early 2000, or maybe it was 99, eBay bought 18% of Mercado Libre. And that wasn't, it was a corporate VC investment. Now, that was very problematic for Mercado Libre because Amazon didn't want to buy Mercado Libre. No one else was interested in Mercado Libre, because when eBay bought that stake, they had a ROFR, a right of first refusal. And so this becomes a deal breaker for me when you've got a corporate VC asking for specific terms. If they're playing on fair terms and they're coming in with monarchies on a deal, and it's just a light kind of normal terms, and they don't have some kind of ulterior motive, then I think it's fine. And I think it can be actually quite strategic depending on who the partner is. But you have to watch out for a wolf disguised in sheep's clothing, right?
I totally agree with Brian. It's been amazing to have you here, and I wanted to show to everyone what is Latitude and your vision, just to have this picture here. I think you guys are building something really nice for Latin, and then we can close on your thoughts about it.
Yeah, I mean, listen, the idea for Latitude came about when I was waiting for Kaje to approve our deal, and I basically decided to distract myself and take as many calls as I could from founders to see if I could be helpful. And I ended up taking 150 calls from founders and just giving advice and trying to be helpful. And I was blown away by the talent and the quality of the entrepreneur. And I basically found myself giving a lot of the same advice to everybody, where I was, helping with fundraising, helping with, building a product engineering team, PR, like how do you manage all this stuff as an early stage founder? And so instead of me giving the individual advice, I decided to form a team of people. And, there's 8 of us. And basically we run cohorts, which are equity free. We don't take equity. And we basically brought in an amazing network of advisors and mentors. And it's a 4 to 6 week program. Ideation is our focus for this next cohort in June. So it's like, maybe you're working at a top tier, venture backed company, and you want to, you ran growth and you want to peel off and start your own thing. This is the place that you go to start your next venture. And then we occasionally invest in some of them now that we have a fund. But ultimately, our goal is to just elevate the ecosystem, democratize access to more information, and then build a community of people helping each other. And so I think that's kind of the mission, is to try to help the next generation of iconic companies to come out of Brazil and Latin America.
Amazing. I hope we can partner in the future. The next companies will be very cool to be very close to Latitude. Brian.
Absolutely. You guys should attend the demo day we're going to have. It'll be probably in July or something. And if you send me an email, I'll make sure that you're included there. And I'm going to actually attach a little video in here. If anyone wants to learn more about Latitude, you can see this little video. We haven't really promoted it much publicly, except for we got some good PR today in Estadão. But yeah, this is kind of what is Latitude, and then this will kind of give you some more information about kind of what we're doing.
Cool. Do you want me to play it here?
If you want, I mean, I don't. People can watch it on their own. I don't want to force people to watch it while we're here, but just so you have it for the benefit of the people here.
Cool. I will make sure they will receive the link.
Cool.
Well, thank you, Brian, for being here with us, sharing all your knowledge and your experience. It was really cool to have this masterclass with you. Thanks. And if you want to leave anything to the public, to the investors or portfolio companies, the stage is yours again.
Oh, Maria asked for the book. Let me pop that in here. This is the Portuguese version. I actually went and did a version in Portuguese too. So if you want the English version, I also did if you like audiobooks, I'll post that as well, so you can make your choice here. But yeah, I guess last words. Well, first of all, I think it's great that you're bringing together people and sharing knowledge. Like, to me, that's really part of the mission I have as someone who's a big believer in the ecosystem and someone that cares about the future of Brazil and LATAM. I'm very grateful for the time that I spent in Brazil. I have uma brasileira em casa. Minha filha nasceu lá in São Paulo. So I have obviously a personal connection to Brazil and, miss the food and the people. But, I would just say my last words are, we're in day one. This is early in the ecosystem. So, I think that if you know anyone that's starting a company, send them our way. It could be, even before they've have their idea, and then we can send it back to you, and you all can fund them. And we're very all about share the love, right? Most funds are like, we want to keep it to ourselves and we want our 15%. We'll take 2%, we'll take 5%, we'll take, and we'll do a 25K check, we'll do a 250K check. So it's all about sharing the love. And I think that should be the spirit of this early stage, so we can elevate more companies together.
Amazing. Thank you, Brian. And Maria, I'll give you my copy as soon as I finish. I'm like 20 pages left, I think. So it's amazing.
Pick it up and share it. If anyone has read the book and likes it, please write a review and then and on Amazon and share it with your WhatsApp groups if you like it. It was a bestseller in the US. It was the top selling book on venture capital for 2 weeks in the US. Cool. And so I haven't been as good at promoting about in Brazil, but it's definitely something to take a look at if you prefer to read in Portuguese. So thank you.
I'll help you with that. Don't worry.
Gustavo, obrigado. William, grande prazer, and thank you for making the space for me.
Obrigado,
Brian. It was a pleasure. Thank you. Bye-bye.
All right. Tchau, tchau. Bye-bye. Prazer.
Bom, mais Masterclass entregue, Gustavo. Obrigado, pessoal. Parabéns aí, Gustavo, pela organização e tudo. Foi bem legal.
Bom, pessoal,
isso foi
espero que
um dos
tenham
melhores.
gostado aí. E vamos nessa aí.
Valeu, tchau.